Welcome back to Gorgeous Graphs. In this video, we continue our look at the effects of inflation on long-term investing, this time with an even higher level of monthly contributions. The scenario starts with an initial investment of $10,000. Every month, $500 is added, and the assumed annual return is 7%. We followed these investments for 40 years, comparing three possible inflation rates: 2%, 4%, and 6%. The red line represents the portfolio under the lowest inflation rate, 2%. The blue line shows the outcome when inflation averages 4%, while the green line tracks performance under a challenging 6% inflation rate. As the animation unfolds, all three curves rise significantly over time. However, the separation between them becomes increasingly obvious, reflecting the fact that inflation steadily erodes real buying power. At the end of the 40-year period, the red line finishes with the highest real value, over $600,000 in today's money. The blue line, at 4% inflation, achieves less than half of that real value, and the green line with 6% inflation ends with far smaller purchasing power despite the exact same investment and return assumptions. This chart is a reminder that nominal growth can be misleading. Even though the portfolio balance might look impressive in absolute numbers, inflation quietly reduces what those numbers can actually buy. By incorporating inflation into your projections, you get a more realistic view of your financial future. As you watch the lines form, note just how wide the gap becomes between the red and green curves. A few percentage points of inflation may not sound like much, but over decades, it can drastically alter your wealth outcome. Let's watch the story unfold.